Adrian Moat joining in this leg of the conversation. He's someone who's been watching India, tracking the Indian market for many, many years, for decades. And therefore, that perspective is going to be very useful right now. Adrian, great to have you on. Thank you for taking this quick call. You know, investors in India are not really used to long periods of underperformance, but that's exactly what's playing out now. The growth valuations are perhaps coming back to haunt us. What do you make of the big sell-off that we're in the midst of? It's been a time-wise correction, but now the price correction is also getting pretty savage, especially in mid-caps and small caps.
It certainly is. And, you know, when you look at the charts, the technical situation looks very poor. And I was just looking at how even the Nifty, you know, failed to break above its 50-day moving average, is moving down. And then we've got another sell-off. So there doesn't really seem to be any sort of technical level for the market at this point in time. And, you know, if you go back to your earlier point, which is the valuation of the market, this remains a very expensive market, which is justifiable if it is generating high growth. And I think investors have been disappointed both at the macroeconomic level, but probably more importantly at both revenue and profit growth levels in the market. So this is going on against a backdrop of India being a big outperformer, emerging market funds having a good exposure to India at a time where we've got rising U.S. interest rates, which put pressure on current account deficit countries, including India. And we've also, surprising, considering you'd think it would be the center of the trade dispute with the United States, Chinese equities doing quite well at the moment. So I think that the mindset here for investors is, look, I've been long an expensive market. It's not delivering the level of growth I was expecting. And at the same time, I'm very underweight market like China, which is surprising me by performing well. That might be partly driven by the whole DeepSeek story and people perhaps appreciating the level of opportunity in very cheap Chinese tech names.
You know, the funny part, Adrian, is that all this, if we, for instance, talk about the latest rumblings, which is all about tariff and tariff wars, if anything, I guess markets like South Korea or Taiwan or, of course, China, they're directly more impacted. India is still a very inward-looking market, and our net exports to the U.S. are not that significant in the larger scheme of things. Yet, like you were saying, the Chinese market has started doing better. We're not seeing a big shakedown over there. So in the near term, do you think that could be an added negative for India? Should we be prepared for that China starts doing better despite these trade wars?
Well, I mean, it is doing better despite the trade wars, and I think you are already seeing a flow impact. Remember here we're talking about the Indian equity market as opposed to the Indian economy. Your IT sector is very sensitive to U.S. immigration policy. And there's clearly a dispute between, let's say, the heads of the big tech companies and those that are more MAGA-centric about whether visas for skilled workers should be given out. And if they're not, that is pretty bad news for the Indian IT industry. You've got a lot of steel companies and commodity companies listed, and if you're getting tariffs on the import of steel and aluminium into the United States, there is an impact at a sector level there. But I think a lot of this comes back to just the results season. The results season was disappointing. And when you're an expensive stock and you disappoint, you are going to see share price corrections. So I would suggest quite a lot of this is micro. It's about the earnings disappointing relative to the valuation.
You know, there are so many stocks which are at fresh 52-week lows: Swiggy, Delivery, MRPL, Motherson Wiring, NCC, LIC, GAIL, Coal India, IOC. All these stocks are now hitting fresh 52-week lows. And these are stocks which have fallen 35, 40, 50% from their 52-week high. So, Adrian, what's the advice that you're giving investors now? Sell more of Indian shares, or do you think now, after the correction, there is some relative comfort?
I wouldn't be buying at this point in time because you need to as we've seen, let's say, in markets like China, when the share market peaked a couple of years ago, the correction phase can be quite protracted as valuations move back to the growth to a level that would be justified by the growth rate that they're delivering. I think the retail investor in India has a large exposure to equities. They've done well out of it, and now they're going into a period where that exposure is beginning to hurt them. And they might be willing just to, for a period of time, park a bit more money in the fixed income market as opposed to the equity market. If you're a high frequency trader, I would still be on the sell side. As a saver, I would be standing back and not buying into this weakness.
Okay, I would not be buying into this weakness at this point in time. Adrian, it's a pleasure. Thank you very much. And I hope you come back and speak to us once we know what really comes out of the sort of, talks between President Trump and PM Modi. That's essentially going to be over Wednesday and Thursday. And I think markets will remain very, very sensitive to it as well. Thanks indeed. Well, sorry, go on. You wanted to say something?
I'm sure the President of the United States will say they're the best ever talks he's had.
But do you think it'll yield a positive outcome from an India perspective, or you think at the margin, whether it makes a real dent or sentiment-wise, you think it'll be positive or negative by the end of it?
I think for an hour it'll make a difference, and then there'll be another news story coming out from the White House. I'm getting to the point where I think we're better off watching cricket rather than Trump's Twitter feed for our own mental health, and probably for the performance of our portfolios, because I think it's very dangerous reacting to all the noise that's coming out.
No, absolutely, and it's been overwhelming. Is the Twitter feed, and of course then there's the other stuff, and it doesn't stop. I mean, Saturday, Sundays are not sacrosanct either. And you hear something or the other over the weekend when you come back on Monday. Thank you very much, Adrian. Appreciate you joining us here on CNBC TV 18. I think, the market just about holding the 23,000 mark, 360 odd points.